Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the MACD reversal strategy, a powerful approach that can enhance your trading performance. The MACD indicator is widely used for identifying potential trend reversals and understanding how to effectively utilize it. It will give you a significant edge in the market. You would learn how to recognize key patterns or key signals, set up your trade and manage your risks effectively. Stay tuned until the end of this video to gain a valuable insight that can transform your trading strategy and help you navigate the forex market with confidence. Understanding the MACD reversal strategy. But first off, let's know what the MACD is all about. The MACD, or popularly known as the moving average convergence divergence, is a popular trading indicator that helps you identify potential trend reversals in the market. It consists of three main components, which are the MACD line, the signal line, and the histogram. Each of these components play a crucial role in analyzing the market trends and momentum. The MACD line is actually calculated by subtracting the 26-period exponential moving average (EMA) from the 12-period EMA. This line shows the difference between two average and helps you to gauge the strength and the direction of the trend. When the MACD line crosses above the signal line, it may indicate buying opportunities. Conversely, when the line crosses below the signal line, it could suggest a selling opportunity. Let us see when it crosses above. Let's look at this area. When the line crosses above the signal line and is going towards the upside, signal buying opportunities. While selling opportunities, at this area you will see that the MACD line crossed below the signal line, which is a sign of selling opportunities. The histogram represents the difference between the MACD line and the signal line. The height of the bar in the histogram indicates the strength of the momentum. When the histogram bar are large, it signals strong momentum in that direction. When you see small bars, it signals or it indicates weak momentum. Observing change in histogram size can provide additional confirmation of the trend. From this example, you can see when there are weak signal. Look at this pullback. During this pullback phase, you can see the histogram is building small lines, while during a trending market at this point, when it was moving towards the up direction, you can see the histogram were making large lines. By recognizing these signals, you would understand that the components allow you to effectively use the MACD for identifying potential reversals. One important concept to grasp is the divergence, which occur when price of an asset moves in one direction and the MACD moves in the other direction. What does this mean? For a bullish divergence to happen, when price make a series of lower lows, the MACD has to make a series of higher lows, signaling a potential reversal. Now let's look at an example. This is for a bullish divergence. Is making the chart, the price is making a series of lower low, while the MACD is making a series of higher low. This is actually a divergence and is a sign that a reversal is going to occur. And as we can see from the chart, price move from a bearish trend to a bullish trend. As you can see, it's going up now before it was coming down, as you can see. Now that's for a bullish divergence. Then let's explain that of a bearish divergence. In case of a bearish divergence, in case of a bearish divergence, it occurs when price make a series of higher highs. When price is making a series of higher high and the MACD is making a series of lower highs. When the MACD is making a series of lower highs, this indicates a possible downward reversal. By recognizing these signals and understanding how they interact, you can make more informed trading decisions. The MACD reversal strategy not only helps you identify potential exit and entry points, but also assists in confirming market trends when used alongside other indicators. Now, how can we trade using the MACD reversal strategy? Now that we understand the components of the MACD indicator, let's discuss how to trade using the MACD reversal strategy. This strategy actually involves the identifying potential reversal points in the market and executing trades based on those signals. The first step is to identify bullish or bearish divergence. Like we identify the bullish one here, and we identify this is the bullish one, and we identified a bearish reversal over here. Like we mentioned earlier, divergence occur when price move in one direction while the MACD moves in the other direction. Once you have identified the divergence, the next step is to look for a zero crossing signal. A zero crossing signal, this occurs when the MACD line crosses above or below the zero line. This is the zero line, this line in between the two parts of the histogram, the downside and the upside. If you look at this angle here, you can see this is reading zero. The zero line is where price is at 0.00000. Then conversely, when the crossover crosses below the zero line, it suggests a bearish momentum, which may be an opportunity to enter short. Let's look at this. When price crosses below the zero line, when price or when the MACD line crosses below the zero line, it is a sign for bearish momentum, from bullish to bearish now. That's why it moved over to the bearish direction. And the same case for the bullish direction. When price crosses above when cross when the MACD line crosses above the zero line, it's a sign for long position and is a signal for bullish momentum, as you can see from the chart. After identifying this signal, it is essential to set your entry and exit points clearly. For a long position, you might enter once you see both a bullish divergence and a crossover above the zero line. So once I see the crossover above the zero line at this area, you can enter your trade immediately. And for a short position, you can wait for the bearish divergence and the crossover. After the crossover, you can consider entering immediately. After the crossover, you can consider entering. Next is to consider your stop loss. Your stop loss placement after the crossover. Once we notice the crossover, we can enter. That will be around this area. Your stop loss placement is very important and it's crucial for managing risks. For a long position, you should place your stop loss just below the most recent low, while for a short position, you should consider placing your stop loss above the most recent swing high. This way you protect yourself from a significant loss if the market moves against you. As you can see, you protect it. This is where you put it. Don't forget, above the most recent high, and in case of a bullish trade, below the most recent low. Finally, always remember always remember to practice this strategy in your demo before applying it in the live trade. This will help you gain confidence and fine-tune your approach without risking real money. I did not make any statement about your take profit. Your take profit should be a minimum of 1:1 or 1:2, as the case may be. You can also take profit at psychological levels, round numbers. You can take profit at the closest support or resistance area on the chart. By following these few steps, you would understand how effectively you can use the MACD reversal strategy, and you can improve your trading decisions and increase your chances of success in the forex market. Alright traders, you have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe, and turn on your notification bell so that you would never miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.